Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Have you ever stopped and wondered why a company like Walmart, of all places, would be making its own cryptocurrency? I mean, it sounds kind of weird, right? But what if I told you it's actually a multi-billion-dollar strategy that could also accidentally land you in a serious tax trap? Let's get into it.
Yeah, you heard that right. Walmart is officially in the crypto game. But why? What's the end game for them? And how does a Walmart coin even begin to compare to something like Bitcoin? The answer to that actually tells us a lot about a major shift in how we're all going to be spending money pretty soon.
So what's the real motivation for these corporate giants? This isn't just about them trying to be trendy or cool. Nope. This is a cold, hard, calculated business move that's all about fundamentally changing how money flows.
And here's the absolute key to understanding this. These company coins are not get-rich-quick schemes like some other cryptos. They're what we call stablecoins. Essentially, they're creating their own digital US dollar that only works inside their world. You can almost think of it like a digital gift card, but for their entire corporate empire. So what is the grand prize for going through all this trouble? Well, it all comes down to this number right here. Every single time you swipe your credit card, companies have to pay a processing fee. It might seem small to us, but for a global giant, this is a total game changer. I mean, think about it. For a company that does billions and billions in sales, that 2 to 3% adds up to an absolute fortune. By creating their own digital dollar, they can completely cut out the middleman, the credit card companies, and just keep all of that cash for themselves. We are talking billions of dollars in pure profit.
So when you boil it all down, it's really about three things. First, those massive fee savings we just talked about. Second, they get complete control. With their own coin, your money stays locked inside their world. And third, well, the law's actually starting to get on their side. New regulations are making it easier than ever for these big companies to basically become their own banks.
Okay, so we get why they want them. But to really truly understand the tax side of all this, we need to be crystal clear on what a stablecoin actually is.
It's pretty much what it sounds like. It's in the name, stable. A stablecoin is a type of crypto that's designed to always have a stable value. The most common kind is pegged 1-to-1 with the US dollar. So one PayPal USD, for example, is always designed to be worth exactly $1 US. It's as simple as that.
And this difference right here gets to the very heart of it. Bitcoin is all about speculation, right? Its value is super volatile, it goes up and down. Stablecoins are the complete opposite. They are built for one thing, payments. Their value is intentionally, boringly stable. They're just two different tools for two very different jobs.
All right, we've got the corporate playbook and we've got the tech. Now let's pivot and talk about you, the investor, and this hidden tax trap that is catching so many people completely off guard.
And this is the reaction almost everybody has. You've made a nice profit on something like Bitcoin. The market starts feeling a little shaky, so you do the smart thing, right? You move your funds into a safe, stable coin to lock in those gains. It just feels like you've moved money from one crypto pocket to another. So why on earth would you have to pay taxes on that?
Okay, let's just walk through a super common scenario. Say you buy some Bitcoin at $30,000. It goes on an amazing run all the way up to $70,000. To protect your profits, you swap that Bitcoin for a stablecoin. Now that money never even touches your bank account. And yet, bam, you just triggered a taxable event.
And here it is. This is the aha moment. This is probably the single most important sentence to know about crypto taxes in the United States. To the IRS, crypto isn't money. It's property. And what happens when you sell one piece of property to buy another? Yep, you owe taxes.
You know, this really highlights how you and the IRS are basically watching two different movies. You think you're just moving your assets around for safety. The IRS sees you selling one asset, your Bitcoin, and then buying a new asset, the stablecoin. And it's that sale that triggers the tax.
So, and this is the crucial part, the very moment you made that swap, the IRS says that $40,000 profit you made, the $70,000 you sold it for, minus your original $30,000 cost, is now a realized capital gain. Even though the cash is still sitting in crypto and not in your bank, you now have a legal obligation to report and pay taxes on that 40 grand. And that, my friends, is the Stablecoin Tax Trap. But wait, the tax traps don't actually end there. A lot of people use their stablecoins to earn some pretty nice interest on what are called decentralized finance, or DeFi platforms. You can think of it like a high-yield savings account, but for the crypto world. And, you guessed it, There are tax rules for that, too.
That's right. Any of that interest you're earning by lending out or staking your stablecoins is not free money. The IRS considers it income, and you absolutely have to report it. But here's the kicker. It's taxed in a totally different way than your trading profits.
See, this interest isn't a capital gain. It's classified as ordinary income. That means it gets taxed just like the salary you earn from your job or the little bit of interest you get from a regular bank account. It just gets added to your total income for the year, and you pay taxes on it at your standard income tax rate, which, by the way, can often be way higher than long-term capital gains rates.
So just to recap and make it super simple, swapping one crypto for a stablecoin to lock in profit, that's a capital gain. Earning interest on that stablecoin later, that's ordinary income. Two completely different activities, two completely different tax rules. It's really that simple. So let's kind of pull all this together. It's become really clear that these digital dollars are way more than just another crypto trend. They are a fundamental piece of corporate strategy, and they are here to stay. This is the future of finance we're looking at. So if you're a serious investor, you just can't afford to ignore what's happening here. As more and more huge companies jump into this game, stablecoins are going to be absolutely everywhere.
Which brings me to the final question, and this one's for you. Take a look at your own wallet. Are you absolutely sure there isn't a little tax bomb just ticking away in there? That quote-unquote safe move you made last year could really come back to bite you. It's probably worth a look, isn't it?